We've just looked at how the customer makes decisions and a little bit about the psychology behind those decisions. And now we're going to have a look at just who that customer is. And with the increasing focus on technology, what does this customer of the future look like? We know their expectations are higher. We have a pretty good idea of how they're articulated through the Royal Commission. And we also know that the competitive landscape is changing rapidly. But how do you keep customers engaged? How do you anticipate their needs and preferably tell them what they need before they know it themselves? So for this conversation, if you could please welcome those of my panel who have got a mic on, which is everybody, which is excellent. Jim Christodouleas, who is the Banking and Capital Markets Director for PwC. I haven't actually met these people. I've only talked on the phone, so that's great. Hi, lovely to meet you. Tim Rossanis, who is the Head of Enterprise Uber for Business ANZ, and that's a very big customer-focused and growth area for Uber. No Uber complaints here. He's not taking them. The computer says no. Simone Tilley, who is General Manager, Retail Broker for ANZ, and Catherine Wolthuizen, who is the Consumer Advocate with NAB. She's the Chair of the Consumer Policy Research Centre and a panel member of AFCA. So let's start with something that PwC has just done, Chris, because, Jim, because you've just released this rather detailed report into consumer credit, which gave a really good idea of what consumers' needs are in that area. So how does that translate into broader financial services, if you can pull out the core needs?
Thanks, Ali. And Ali is referring to a report on the future of consumer credit that we've just released yesterday. Look, there are many areas of the report there are some areas that are very specific to the topic. So, for example, the report comments on the saturation of mortgage credit in Australia, which is very specific to the topic of mortgages. But many of them are quite general. So, for example, what we just heard about yesterday in the previous session, the difficulty of consumers understanding their need, the dichotomy between demand and usage and actually fulfillment of underlying services, knowing what we know about behavioral economics and the fact that use and quality are not necessarily the same thing, even though businesses are geared up and designed around the assumption that is, as well as many of the other sort of things that you've probably heard about earlier. I think Brett was here earlier. I mean, Brett's been one of the pioneers in thinking about what technology means in terms of its ability to deliver traditional checking account and banking account services. And I think he wrote his first book 15 years ago, where he articulated a really compelling vision that the industry is still struggling to catch up with. So technology is enabling the delivery of services in new ways. Incumbents, and I know that Simone and Kath will talk about the degree to which they struggle with their legacy operating systems and technology infrastructure to meet all that. And then finally, the issue of responsible lending, responsible delivery of financial services is obviously key in the issue of consumer credit, but obviously applies more broadly to almost all areas of financial services.
And one of the things in the report was that customers are, and I'm quoting now, increasingly confident in being able to identify the best offer at the best price anywhere in the world. I'm just wondering how deep that ability goes. So you can identify best price for a set of power tools, possibly even you can shop around for a mortgage, but does it go deep enough that we are good at identifying, best product for our retirement?
Well, so the word was confident. Whether or not that confidence is well placed is another issue. I think one of the earlier speakers talked about product complexity. There are hundreds of different, I think 800 is the statistic, 800 mortgages that are available right now through the broker channel alone. Now, I cannot think of anything close to 800 fundamental economic permutations around the underlying product proposition. And so that has to add an enormous amount of completely unnecessary complexity and difficulty in the delivery of that product. So I would say that customers are increasingly expecting, and you all see this in your lives, expecting to be able to identify the fair price. We can all search for products online and do price comparisons. We have increasingly functional AI-enabled tools that will perform that comparison for us. We have not yet enabled an AI tool that will have the conversation that a broker can have with you, but that is coming. That is absolutely coming. And so I think it's a progression that is going to be continuing for some time.
Simone, who is the future customer for you? And indeed, which customer are we talking about? Are we talking about the intermediaries, or are we talking about the end user?
I think we're always talking about the end user, but we definitely need to be cognizant. I run the broker channel, the mortgage broker channel specifically, and there are other customers that we need to take into consideration, when we think about that specific channel, and namely the aggregators as well as the brokers. And for context, there's at least 15 decent sized aggregators. Some of them are listed on the ASX. And there's over 17,000 mortgage brokers across the country. And we're all working in partnership to serve the ultimate customer, and that's where we're working together in partnership.
And how do you see the future customer versus the customer of today or yesterday?
I really don't see that changing all that dramatically. I think we're all human beings, and for complex transactions and big decisions, I see that people will want to continue to deal with people in some shape or form. I see that changing over time. There may be time for human interaction, there may be opportunities for chat, and 24-hour, 24/7, the ability to make contact with someone when it suits them at their own convenience. And I think, we talk about complexity, and I literally rang one of the largest aggregators in the country as I was walking down from ANZ up to here to Burke Street, and I asked how many products are on your panel, and he said over 800. And when we think about that, the complexity that a customer needs to face into as they navigate through that choice, and I think it was even mentioned in the previous session, where there's more choice, there's more complexity. And I think the difference as well is helping customers determine and decipher what they want versus what they need.
And I'd love to know of those 800 products, just how different the returns were on, was there 800 different types of return there as well, but that's an entirely other conversation. Tim, tell us about Uber. I mean, your customers are pretty much at they've proven that they're prepared to play with the disruptor. How do you see your future customer?
Well, I think I'm the odd man out on this panel, not being a financial services professional. So excuse me if some of the terms that you guys are using are foreign to me. But I think we can talk about customers. Our business product has been in Australia for just over 2 years, and it's existed for 5 years globally. And what we know is that customers demand value. And what that value means is different from customer to customer. But at the end of the day, the reason that Uber was born in the first place was because our founders were on a rainy street in Paris in 2009, trying to catch a limo after a tech conference, and they couldn't get a cab. It's as simple as that. It was born out of a customer problem, and they realized that taxi providers weren't using technology to have the supply of a car meet the demand of a potential rider. And that's why we came about in the first place. And 10 years of innovation since then, and now we're talking about what do business people want when they're traveling. And traditionally what business people want is simplicity, convenience, reliability. They don't want to have to worry about a receipt that's the length of your arm. They don't want to have to submit a receipt themselves. That's annoying, that's frustrating. Administrators or finance and procurement professionals want to be able to easily reconcile the expenses of their business people going from A to B. And we've built all of our products with the voice of the customer in mind, and actually listening to clients and listening to customers and operationalizing feedback loops within the platform that we've built is one of our biggest competitive advantages. So the rating system that you use hopefully a lot of you are Uber users already, that rating system is not a gimmick. You might think that it's just a cool way of getting you to interact with the platform. It's not. It's actually central to the ability for us to provide a safe level of service to our customers and good customer service. That's how we understand that a driver is potentially a bad actor. That's how we understand that a rider is doing things that are inappropriate in a vehicle. So operationalizing feedback loops through the rating system is a really simple way of implementing technology that has given us a lot of benefit.
Which brings me to my next question. You collect so much information about people we never talk to you, just from what we do, where we live, where we travel to, all that sort of thing. So how important is trust to your customer?
It's extremely important, and credit where it's due. A lot of the data security systems and expectations upon us as a tech company actually come from the financial services industry. You think about GDPR and ISO and PCI, all of these acronyms that we're compliant with. Most of you, I assume, would also be compliant with if you're collecting and processing data. So trust is the cornerstone of our ability to provide any level of service to our regular consumers and our business consumers. And I can only imagine it's the same with all of you. If your customers didn't trust you, there is not a snowball's chance in hell that they'd give you any of their money. So it's critical, and the way that we do that is by providing really good service on a repeatable basis at scale. So doing millions and millions of trips a day, and the vast majority of them, 99.99, go off without a hitch. And that's the magic of Uber. One button, you get a ride, and then you're picked up. You can see the car along the way, it's coming to you, you know where it is, you don't have to guess. And we all remember the good old days of calling a taxi first thing in the morning for a flight. And say,
We've got it
5
now,
minutes.
we've got the message.
So,
It's a nice ad for Uber. Catherine.
that's why I'm here.
Well, exactly. The future customer, from your point of view, is it a different beast to the past customer?
I think we're increasingly seeing that, and there are definitely, I think, demographic elements and dimensions to that. So just continuing the thread of some of the discussion here around customers, what customers want from products, what they want from experiences in financial services. And certainly from what I see, where there is a relationship, and particularly where there's been a long-standing relationship with a provider or an institution, the expectation there is for loyalty benefits that would accrue as a result of that long history and a person's circumstances and where they are in life. And that might be something you would see more amongst older customers. You've then got, customers who are very free from that. They don't have long-standing relationships. They're much younger. They're just starting out on their journey towards kind of financial well-being, which is the outcome that they're looking for. And their expectations are very different. And that's when you do see expectations around speed, simplicity, make it easy for me. I've got so much else going on in my life. I'm having to be making choices and decisions in a whole range of other markets. My life is complex because I may be working in insecure employment and I'm having to juggle an awful lot of complexity. It's nothing in my life is a set and forget. And so it's not your interactions with those customers, your ability to recruit them and retain them are going to be on the basis of very different kind of product and process that you can provide to them. And that's where that simplicity, I think, becomes even more essential because they don't have they're going to be much more susceptible to disruption. And obviously we're already seeing that in the credit market from new providers coming in with a totally different credit model and really being very successful. And at this point, in the early stage where perhaps some customers who are using those products haven't yet experienced some of the downsides that can come with them.
Can I ask you about the downsides? I mean, what do you see as the biggest complaint area of the future customer?
For customers in general, I think that it's that you've relied on my consent to something when I didn't actually knowingly consent to that. And I think that's we're in a real transition point, and the Royal Commission, I think, really highlighted this, the move away from disclosure as a tool to capture customer consent to product design and outcomes that are framed from the provider perspective rather than from an understanding of what the consumer's expectations of outcomes actually are and what they're expecting you to deliver, whether it's an investment product, a basic savings product, a credit product, an insurance product. And certainly I've watched that kind of play out from when we saw deregulation in financial services accompanied by disclosure regimes as the means of providing baseline consumer protection, not being successful, bringing us to a point where we have a Royal Commission Commission that looks at the quality of outcomes that that regime has produced and is now really pushing for simplification from a regulatory perspective, but also, as I said, simplification from that market and from new challenges coming into the market to take advantage of the fact that trust has declined so markedly amongst Australian consumers.
It's an interesting point about not using disclosure as a form of consent. And if I can bring you back in, Jim, you see the future customer as actually having less responsibility. You see a responsibility shift to the seller. I just wonder, though, whether that is linked. It's a similar...
Yeah, so it's a good point. So there are a couple of points to call out. I think that if you look superficially at the conversation around responsible lending in the press, certainly in a lot of the Hayne hearings, one could come to the conclusion that there has been a shift from caveat emptor to caveat vendor. The Perrin ruling, by the way, was, you could say, was a voice against that. That was the ASIC case in which the case against Westpac was overthrown. In our thinking, the whole discussion of borrower responsibility versus lender responsibility, it's the wrong dichotomy. And the reason is the following: at the end of the day, the ultimate responsibility for looking after one's interests rests with the individual. There's no system that you can create that violates that principle. However, financial services companies do have a responsibility, first for making sure that they don't deliberately harm people, but even more important and harder still, to find ways of empowering customers so that they can exercise that responsibility, knowing that they're real humans. And this gets to the conversation around behavioral economics, right? People don't want to look after their own retirement. They don't want to look through their transaction statements and know what their actual expenses were. But we still have to help them do that anyway. Now, the question is, do customers expect it? And I think the Uber experience has an important lesson for financial services, and that is this: what customers expect is highly dependent on the context. So no one will expect the Uber experience from the taxi industry. Ask anyone at Cab Charge or any of the affiliated customers until someone delivered it, and then suddenly it became an expectation. The other warning I think that the taxi industry gives to this industry is it's very easy to overestimate how quickly you can respond when those customer expectations change. It's been 10 years now since Uber has developed, they've proven the proposition. You just have to copy it. And the taxi industry has failed to do so, not for a lack of intellectual understanding about what customers want or what is possible, but it's just when you have an incumbent organization, it's hard to shift. So I think if we step back and answer the question of borrower responsibility with that lens, which is that borrowers have a responsibility, it's a taxing responsibility to carry out. The financial institution that works out how to help customers do that is going to be incredibly successful in the decade to come.
And Simone, is that a mixture of technology and people, as we've been hearing on earlier panels? It's a hybrid solution?
I think it is a hybrid solution. I think further to Jim's comments, I see there being a hybrid obligation as well, like in terms of borrowers having, are more informed about the decisions they're making, but that obligation sits with the lender to make sure that when they're sitting down in front of the customer, they're being more transparent, really clear about the structures that they're entering. If it's a fixed rate contract, what that actually means to an average Johnny and Jane across Australia, so that when they are entering into decisions, they've got all the facts, they've been taken, you've got the care and the duty, the obligations, especially for vulnerable customers, those that, looking for those that are experiencing financial abuse, and just really, for us to make sure that you've got the right rigour and care to capture those that, we've perhaps missed in the past.
Which obviously, going back to the question, or as part of the question about using technology, I mean, Catherine, how adventurous are consumers in the financial space? So taxi service is crap, I will take an Uber. Not a big risk as far as I can see it, as long as the driver gets me where I want to go. A bank is crap. It's a much bigger decision for me to decide that I'm going to go with a Volt Bank, or I'm going to, completely change the way I do things.
I guess it depends what you want them to do. And if it's I mean, certainly the experience overseas from challenger banks, it's that they're very good at recruiting customers to simple products. So in the UK, you can see Monzo signing people up to transaction accounts at a very, very fast rate. Now, whether they can then translate that into other relationships that are deeper and more enduring, well, I guess we'll have to wait and see. But certainly in terms of getting people over the threshold, if you can establish a credible brand and a credible offer that is attractive and seen as a genuinely attractive alternative to established products in the market, that indicates that there is the potential to be successful in that. So I'm not sure that there's the same kind of trust barrier, especially where you've got incumbents in a market with low levels of trust. So making it easier for challengers to come in with new brands. I guess on the data point, just back to that consent issue, that's a really live issue. What is the level of consent? What is the offer that is going to be put to customers to consent to greater use of their data, or in a different regulatory environment to consent to continuing use of their data? And I think around vulnerability, around putting forward a case to customers that access to data is actually in their interests. It can be beneficial for them. It will support banks to genuinely understand how to better support them achieve their better outcomes, their desired outcomes, I think will be extremely important.
And that's exactly how Uber does it, isn't it? I mean, it's a really easy sell in some ways, that the more data you give us about you, the more I'll be able to help you get picked up earlier, get taken to where you want to go faster, that sort of thing.
Yeah, look, it becomes natural. It's not something, obviously we have customers consenting to providing data to us, but I think the dynamic has shifted a little bit, where the onus might have been in the past on the provider to request the consent, and then the consent to be actively given because you don't necessarily trust the provider. For us, we're automatically trusted in most instances, and I think maybe that's where there's a difference between my industry and your industry, is especially post-Royal Commission, that trust dynamic might have shifted. It's not automatically given anymore. Now it's, you have to prove it to me, and then I will give you my data.
So what have you learned about customers and technology that applies beyond Uber to people in this room?
A lot. At the end of the day, what we take away from the data that we receive is behavioural insight. So we know what people are intending based on the way that they shop on our app. Something as simple as moving the button from one part of the screen to another part of the screen, and then A/B testing the results of that versus that user experience, and then doubling down in the one that gives us better results. That type of thinking you don't see in most industries, but you do in technology, and especially in a technology like ours that's very fast-paced, and we're transacting lots of trips on a daily basis. So we, at that level of statistical significance, with that level of trust, we can learn rapidly, and then we can iterate and experiment rapidly. And then using data, I think that's really the most important point, is using it to learn as quickly as you can. Don't just test one thing when you can test 100 things.
Well, I'll ask Jim and ask Simone. I mean, the points made there about Uber, how do you apply that to your own?
Look, I think we all want to get to a place of predictive analytics and using behavioural data points so that we're able to, have a wider lens of the customer in totality.
But that's low-hanging fruit, isn't it, really? Because in many cases you've got a lot of the information.
The problem we have is, particularly the larger institutions, is the issue of legacy, and legacy assets and infrastructure. And, the dream is really having one repository of information to draw upon that can be used for multiple purposes. And at the moment, we've got future state and we're working really hard towards it, but you're really sort of oscillating between old world and new world. And you make points of comparison to say new players, more smaller, nimbler, niche players, they're able to propel forward faster from an infrastructure viewpoint because they don't have the legacy infrastructure, to deal with. But ultimately, the predictive analytics and the data points that Tim speak of is exactly where we're going, and we've definitely made some inroads, and we're not short of data, as you know. It's just how we use it and how fast we can galvanise that so that we're actually providing more meaningful analytics at the right points in time so that we can assist with the right sort of decision making.
And Jim, the challenge is, isn't it, to fast forward that process and at the same time deal with the regulatory issues and the trust issues.
Right.
Yeah, that's right. That's right. And this industry is blessed and cursed. So you mentioned customers have inertia, they have a risk aversion, and that's true. And Brett was here earlier. He created Movin, I think, over 10 years ago, articulating all the ideas that he articulated in his excellent book, Bank 2.0, and subsequently. But I don't know how much share he's really taken from Wells and Bank of America. And so, the big banks are still the big banks. And so there is a privilege that comes with a kind of incumbency and the natural conservatism that customers have, which gives incumbents a lot of room to take their time. Now, the flip side of that is you can very easily find that the time has run out before you realized it. And so the absence of a burning platform, coupled with all the other things that Simone knows very well about, the analysts' calls that want to know whether your share has gone up 1 bip or 2 bip, and all of that stuff that you have to deal with, I think, is what makes it especially challenging to deal with an environment that is slowly changing and therefore requiring.
But is that slowly changing a generational thing? And suddenly when my teenage kids are, actually caring about their bank accounts because they're actually earning some money, which would be good, that the game will change because they are just digitally in an entirely different space to someone like me.
Yes, and if you look at you don't see this in mortgages, and the fact that you don't see it in mortgages is in a sense one of the reasons. Again, I'm just speaking specifically in banking, but I'm sure people who are in super fund investing. But if you look at consumer credit and you look at the take-up of Afterpay, and I know it's a controversial business model, but that is an example of which an entire generation of people have fundamentally changed their dealings with a very tiny, insignificant section of the consumer credit market. But we believe, and we talk about this in the report, the lessons for the big game in mortgages are extremely important and extremely worth understanding.
Those transactional points effectively the point of departure for customers, to remain on WeChat, to remain on all these different platforms, and particularly when you've got intergenerational affinity for digital tools, that's only going to, magnify as the years unfold.
And Catherine, as financial services look to serve this customer of the future, you said something quite interesting to me that you can't just use technology for product sale, if you like. It has to be taken beyond that.
Because obviously simplification and digitisation brings with it all manner of benefits and opportunities for providers in financial services. I think, though, the trap is that you start to look at as technology as just an enabler for doing doing what you used to do, but doing it in a quicker way, or as a means of fixing the customer, a different way of fixing the customer rather than fixing your products. So whether it's using it to communicate differently with customers, whether it's using it to nudge customers in the way that you want them to go, or the way that might actually push them towards getting more out of the products that you're providing. But it's not necessarily going back and taking the sludge out of your products, the counterpoint to the nudge. It's not necessarily you interrogating the product features that you're trying to nudge customers away from. And a lot of that is, I guess, it's hard to be innovative if you're a big institution that's got a lot of products and a lot of legacy systems that can frustrate that capacity to innovate. And I think, as Jim was saying, that it's not just customer inertia; it can be institutional inertia. That if you have the benefit of that incumbency, you're not feeling that heat that the new challengers are going to be feeling to try and get that toehold in the market, to try and come up with some different way of reaching out to customers, different way of understanding their evolving needs, and providing a more direct way of meeting those needs. And your capacity to respond to that is going to be limited.
And that anticipating needs, Tim, I mean, that's something that Uber, you're trialling driverless cars, but also you've got the helicopter. One has lots of money and they're they need to get to JFK fast so they can take a helicopter. So you obviously use your data to work out what the customer might need, and then you tell them before they even know it. How far can that go?
Look, the sky's the limit, excuse the pun. I really think that there's an endless number of areas that we can delve into that are going to change the way that people move around cities. But I think the cautionary tale here on this topic is how quickly innovation can take hold, and this is to Jim's point earlier. In 2009, when we launched, we were essentially just a black car limo service. Within a couple of years, we were regular hybrid, Camry, regular cars on the street, and now we're in 15 or 20 different categories, and we've taken over pretty much the entire industry. And that's in a really short space of time. That's 10 years. And there's this buzzword in technology. Technology is all about democratizing whatever it is that you're trying to work in, your industry or your function. And democratizing is a simple way, maybe a fancy way of saying something really simple, which is the barriers between you and your competition, whether that's your parochial traditional competition or the new innovators that are coming up from the beginning, those barriers have been broken down. And it's very easy nowadays to move from one provider to the next, much easier than it was even 5-10 years ago. And that's where the important message of our story, I think, is something that's relevant here, because if you don't innovate, then you could be in a lot of trouble. There are a lot of tech companies that are famous for building models of what's going to kill them. What is it that's going to kill you? You should have your entire leadership team sit in a room and do a war session for a day on how your company can get killed by an innovator that's coming up and disrupting.
What could kill Uber?
Look, it's good.
So we can all go and invest in it. Can you tell us?
Sure. I'm not anywhere near smart or important enough to know the answers to those questions.
So Simone, post-Royal Commission, the refrain from so many very senior people in financial services is that we no longer ask, can we do it? We ask, should we do it? Now, if the end result of that, I really doubt this is going to happen, but if the end result of that in a couple of years is that bank profits are actually, quantifiably changed, is that a saleable outcome? That, look, we've actually looked after our customers better, so you as shareholders have just been squeezed just that tiny bit, but we've looked after our customers.
I think it's always going to be hard striking the right balance. I think from a stakeholder viewpoint, I think there's probably more education than ever from an awareness viewpoint around the why we need to change. At ANZ, we've just, it's a huge emphasis is around remediation and simplification. I mean, we've had thousands of products that have been grandfathered over years and years, got legacy, spoken about the legacy infrastructure and the assets and the complication. We recognise we need to be simpler. And I think, to be honest, an observation I've made is, often there's, the quest for, when you have your investment slates, there's always someone that's noisy and gets excited about red shiny new toys, but now the direction of energy is really around what do we need to fix, what do we need to, what's the right thing to do, what should we do, even if it comes at a cost to that point. And that is a real conversation that is taking place on a daily basis. And even from an audit viewpoint, when we're getting audited, if there are businesses that are seen to put off the hard stuff in pursuit for sort of revenue accretive matters and not addressing the things that they should be, that is absolutely being called out and being disciplined accordingly. So there is that conversation and that dynamic so that there's the right conversations taking place for the right reasons.
Jim, it'd be interesting to see whether B Corporation does actually ever take off in this country.
Whether, sorry?
The B Corporation, the benefit corporation, which is becoming increasingly prominent in the US, where you don't just have a for-profit motive and you actually sign a constitutional.
Yeah.
Are you a cynic of the B Corporation?
No, I'm not. So I think, and certainly the way we advise clients to think about this, is a lot of the so-called conflicts between shareholder interests and et cetera, and customer interest or other stakeholder interest, if you think about employees or advisors or partners, a lot of those go away the further the time horizon you think about. Any business is a collaboration of different stakeholders, some who bring their labor, some who bring their capital, some who bring their demand, and that has to benefit everyone, otherwise the system breaks down. So many of the problems we have, frankly, are simply problems of time horizon and imagination rather than anything else. When we first wrote the first Future of Banking report, which articulated this idea of simpler, smaller, more deeply connected, I'm going to sort of share something. We shared it internally within the firm. And people said, oh, love it. But surely when you say smaller, you don't mean less profitable. And we said, probably. There are returns that didn't look to us to be very sustainable, and there were certainly revenue streams that didn't look to us to be sustainable. So a business that were short-term less profitable, but that were grounded on a much more sustainable basis, struck us as a pretty good long-term proposition for shareholders, even if no one liked the short-term implications. I think there are many examples of in the last 5 years of fees that were waived that were quite material in terms of short-term profitability that were justified only within the context of saying this will make our business much more sustainable over the long term. And yes, analysts, I know you're shouting about it, but your clients will be long-term better off for it. We've seen Big Four bank profitability decline now for 2 years running. Who knows how long that will last? But at the end of the day, if the value proposition is a fairer exchange of value for customers, it's difficult to see how shareholders aren't better off.
I just want to finish with one very, very quick thing. In this report, Jim, the consumer credit report, you talked about banks being, smaller, as you just said. But that said, that may not require or necessarily mean fewer customers, but rather a narrower and a clearer focus on who the customer is. So my question just briefly at the end is, are some customers of the future going to drop off the perch? Simply not be sufficiently of interest to be served?
Yeah, that's a good question. We debated that as we were writing that report, that idea for some time, and in particular, and this is particularly relevant for the Big Four banks because they have universal service obligations, and so I suspect that all customers will find providers who will find ways of appropriately and profitably serving them. But our counsel is always, for every particular business, they need to really think about how they identify the customers that are right for them and that they're going to build their franchises around. And in general, our feeling was when we look at some of the large financial services providers, not just in banking, et cetera, the reluctance to do that meant that a lot of poor trade-offs were made because you can't be all things to all people.
I'll just sort of add in there, I think smaller doesn't necessarily equal less profitable. I think it just sometimes might be more efficient. And I think one of the things we will see going forward is stronger elements of segmentation and improved clarity around risk profiles. And I don't necessarily think that means customers will miss out. I think that it makes way for new players. And we're seeing that already. And I think the market is morphing. But the other part that we need to consider is not only just sort of lending money, but the responsibility and the obligations that we have and the higher expectations and the societal expectations placed on larger institutions to serve the Australian market honourably. And, I think they're the sorts of things I think we'll start seeing playing out over time.
You optimistic?
Yes, and I would also just sort of say in terms of the kind of profits that we refer to in the kind of halcyon days of profitability of the last kind of decade or so, how illusory some of those profits were when you start to take account of the mounting remediation bill.
Right.
So if it's founded slightly on sand, and we can, the example of this is PPI remediation in the UK, where it tipped 60 billion by the time the deadline kicked in for refunds, indicating that you've got to building a sustainable business. You're more likely to get more sustainable profits.
And Tim, Uber, do they? Your customer is pretty broad, isn't it? I know that you're looking at business as obviously a separate customer unit, but anyone who ever doesn't get served by Uber?
Well, I agree with the comment that you can't be everything to everyone, but I also think that good customer-centric business practices are around going to your customer. When you know who your customer is, you need to go to them and match their expectations. So we've done a lot recently around pulling public transport data into our app, because we know that people don't just want to use us to get from point A to B in a car. They might also want to see how do we take the train to point B and then take an Uber from B to C. So building more of a platform where there are multiple types of interaction that a customer can have with us. That's really important. And I think just on the point about profit and growth, maybe just one comment there. For me, a lot of that is also about managing expectations, because at the end of the day, for us, for example, our objective at the moment is growth and scale. We're trying to grow, we're trying to enter more markets, we're trying to launch more products. Our shareholders understand that. That's part of our story. And doing that in a sustainable way in the long term is going to build out the ability to generate profit in the long term. But we've managed those expectations very clearly. I think that is a reflection of how we treat our customers too. They know what to expect from us because we're very clear about it with them. And in times where we do the wrong thing or we make a mistake, you and I spoke last week about if you ever have a complaint about an Uber trip, we'll refund you pretty much immediately because we've got data and insight based on our platforms where we know using machine learning and AI that the driver's taken a wrong route and you got charged $40 and it should have been $20. We'll, in an instant, give you the $20 refund. And our degree of confidence in making that assessment based on tech is really, really high. So I think there are a couple of interesting lessons there. I just wanted to share a bit more context.
The expectations around profit, though, I mean, gosh, heaven help an ANZ if you said to your retiree that your 7% yield is suddenly going to become 3%. But that is for another day. Please join me in thanking our panel, Jim, Tim, Simone and Catherine.